Right, guys, welcome back to Keen Knowledge 7. Here we're talking about sources of finance. Here is our study design. Here is where it sits. And you see sources of finance available to establish a business and the facts affecting the type and source of finance chosen. Okay, that's where we're headed with this one. So what is this all about? What are we talking about? Every business needs money to set up and operate, okay? When planning the business owner needs to think about where that money is going to come from. That's essentially what we're talking about. Sources of finance. Where is the money going to come from that you need to start your business? Simple as that. Now, you've got a range of options. That's what we're going to take you through in this video. And the way that we're going to categorize them is through these 5. Now, notice these are not given in the study design. The study design does not identify, like it does with some key knowledge dot points, the things it wants you to know about. But these are realistically the 5, and most textbooks would cover these 5. So this is our script for this one, even though the script is not provided in the study design. Okay, so that's the 5 we're going to be talking about. So first up on the list was equity capital. Now, this is money contributed to a business in return for a share of that business, okay, partial ownership. So someone gives you money in return for a share of the business. So they're kind of buying part of the business, effectively. The size of the share that the investor receives depends on the amount of money that they invest. Makes sense? The more they invest, the bigger the share of the business. Now, it's important to note that if things go wrong down the track and the business ends up bankrupt, owing money, the business does not need to pay equity capital back to the investor, okay? So if things go wrong, the equity investor does not get the money back. That investor understands that they are taking a risk when they're investing in the business, okay? They stand to lose their money. Obviously, they want to take a calculated risk. And if you think about it, if you've ever seen Shark Tank, this is the premise on which this works. You know, the person stands in front of the 5 sharks, and they said, you know, this is my business and I'm looking today for $100,000 for a 10% share in my business. That's equity capital working for you. So if they're wanting 10%, if they're willing to give away 10% for $100,000, what they're saying is I'm valuing my business at $1 million because the 10% of the $1 million is the 100,000 that they're going to pay. And then, of course, what happens is the sharks generally value their business at lower than that. So they either, want to get a higher equity share for that same money or less money for the same equity share, so on and so forth. But that is exactly, if you watch Shark Tank, this is how it works, okay? So the key thing to remember here is the equity does not need to be paid back if things go wrong. And that is different to some of the others that we're going to look at shortly. Now, 50% is a key number with equity. If an investor buys a more than 50% share, that means they're going to have a large influence over major business decisions because they're a majority shareholder. They own the majority of the business now. They have a huge influence. So if you're thinking about setting up your own business, do you really want to give away more than 50% to a particular shareholder? Because then you lose some control over your own business. Just some headlines here. And it's funny because you see these headlines in the press and it's often so-and-so to acquire a 51% stake in such and such business. And the reason they're doing this is for exactly that reason. If they buy the 51% stake in a business, then they kind of have a controlling influence over that business. So that's what that's all about. So you often see this 51% in the financial press when we're talking about businesses acquiring other businesses. That's the reason for it. Now, there's actually 3 types of equity capital. Okay, personal equity, which is the owner contributing their own funds. Private equity, which is where you're selling shares of the business to other private individuals or businesses. Could include family or friends, or it could include a Shark Tank shark. Or public equity, which isn't really relevant in the context of where we're going here, because we're talking about planning and starting your own business. This is where you're selling shares to the general public via the Australian Securities Exchange, the ASX. That's really only available for a public company. And we said when we were looking at legal structures or business structures that when you're starting a business, you can't set up a public company. You might become one down the track, but in terms of starting a business, so if you're starting a business and you're going down the equity route, really personal and private are your realistic choices. So which way to go from those three? First off, like I just said, public equity is not going to be an option for a new business. It takes time to reach a stage when you're going to be able to list on the ASX and attract public investors. Okay, this is not something you do right off the bat. It's also really expensive, very complex, very risky. I talked about IPO. That's when you list on the stock exchange. It's called an initial public offering. That's when you publicly offer shares in your company for the first time to raise capital. Again, down the track, not something that a new business owner is even going to be thinking about, not an option that's available to them. Afterpay, I say it a long time, Afterpay actually listed on the ASX really, really quickly, only 2 years after starting, which is very, very unusual. So they grew so quickly that by selling shares to the public at that point, that was what allowed them to actually expand into overseas markets. But that is very rare, from start a business to going to the ASX and having an IPO in the ASX. Super rare to do it that quickly. Usually it takes many, many years. So realistically, that leaves you either personal equity or private equity. That's your two choices. So how do those two weigh up? Okay. Personal equity is obviously going to limit you to the amount of savings that you personally have, whereas opening up to private equity is giving you access to more money, other people's money, obviously. If you stick with personal equity, however, you are going to retain full control over the business. But as soon as you open up to private equity, it means you're going to relinquish some of that control. So I said before that 51% is that magic number. If you really want to retain control of your own business, don't go above the 50. But even if you relinquishing 20, 30%, whatever it is, those people then can expect to have a say in the business. So if you really, really want to retain control over your business, over your destiny, as much personal equity as possible is going to be preferable to private. But then on the flip side, do you have the money? Okay. But of course, don't forget that we're looking at other sources of finance in this video as well. So you can have kind of a mix of both. Business structures, sole traders and partnership, personal, probably private limited companies often might go to private equity is how that tends to play out. Debt capital is the next category. Okay, so we talked about equity, now we're talking about debt. So this is kind of almost the opposite of the equity. So this is money that has been lent to a business by an external source. So this money, as a business owner, you're borrowing and you have to therefore pay it back, okay? Unlike with the equity. So the most common form of this is a bank loan. So you go to your bank manager and say, look, I'm starting this business. I need $100,000 to get me going. What do you think? But there's lots and lots of other financial institutions which offer business loans as well. It's not just banks. There's tons of others. So if you're going to go down this route, you do a bit of investigating, probably talk to an accountant and look at the different options available to you. Now, this is quite expensive because not only does the loan have to be repaid, but you're also going to be repaying interest on that loan as well. And if you think about where we are now in December 2023, interest rates have been rising consistently over the last 12, 18 months. And it looks like they're expecting them to kind of continue to do so in the coming months. It means that loans now are becoming more expensive to repay than they have been for years. So again, it's another factor you need to build into the equation if you're thinking about going down this route. On the flip side of that, the lending institution doesn't gain any ownership in the business. Okay? It doesn't matter how much they lend you. It's just a loan for the business. You're paying it back. They have no ownership in your business at all. So therefore, you retain full control. So realistically, think about equity versus debt. Both of them have their advantages and disadvantages. And again, it comes down to choice, which is going to make more sense to you. Now, one thing to bear in mind with debt capital, it can be difficult for new businesses to acquire a substantial loan, a large loan, because there's no track record of success to prove that loan can be paid back. We talked earlier about the number of businesses, I think in the first outcome, the number of businesses which fail after the first year, the first 3 years. So it's risky for a bank to lend a new business owner a substantial amount of money when, there's a fairly reasonable chance that that business is going to fail and the bank might not end up getting its money back. So what the bank will need you to do at least is to provide a really detailed business plan, which identifies your plan for how you're going to run your business. And we look at business plans in more detail later as well, so that the bank at least has some kind of level of security that this is a business that might actually work and they might see their money again. Might be easier for a private limited company to access loans than sole traders or partners, just because of that incorporation and the legal separation of the owners and the business, and the fact that if you're a private limited company, you've kind of jumped through more hoops. It's more regulated than sole traders and partnerships. So that can kind of add to your ability to get the loan if you set up as a private limited company, which again, when you're making the choice about business structure, that's another factor that might lead you in one direction or the other in that area as well. Now, the third of our 5 types is a grant. So a grant is a money given by the government, could be federal, could be state, could be local, for a specific reason. Okay, there's grants for lots of things in life. In this case, you'd be applying for a grant to assist in the start-up of a business. And there's lots of these out there, okay? And this is something that if you're starting a new business, you definitely want to explore this route because it's kind of free money. If you can access these are a low-cost option because you do not need to repay it. It's a gift, a grant. The money's given to you. You do not need to repay it. And also, whoever's providing, whichever level of government's providing, is not claiming a stake in your business either. So you're neither paying it back nor giving away a share of your business. So it's kind of a win on both of those fronts. The only downside to this is there might be a list of conditions imposed by the grant provider which can limit your ability and what you can actually use the money for. So while it might be for business startup, when you start looking at the fine print, there might be only certain aspects of the startup that you can actually use the money for. But absolutely, you'd be crazy to not explore the grant avenue when you start a new business. And like I said, there are a lot out there. You can do some search in the internet. It's quite surprising how many local governments offer grants to new business. And look, actually thinking about that, why do local governments offer grants to new business owners? It's in the interests of a local government to have as many profitable, successful businesses operating within their remit as possible. Because number one, they're going to be paying certain taxes back to the local authority, but it generates an income for the area. Like in so many ways, it makes sense for local government to provide grants to potential small business owners to encourage small business operate in their area because it kind of comes back to them in the long run. So that's kind of the reason. Fourth one was overdrafts. This is simply an agreement between a bank and a customer that allows your customer's account to be withdrawn below zero. Okay, so you can have a negative bank balance. This also applies to people as well. Okay, so if you're, your bank account's running a bit low and you've got some expenses that need to come out next week or in the next couple of weeks, and you know that your wages are not going to hit your account, you can call the bank up and say, look, can I have a temporary overdraft? Which basically means that if your bank account balance is $1 and you have an agreement for $1,000 overdraft, you can still withdraw money up to that $1,000 overdraft. That's what an overdraft is. But it applies equally to a business as an individual person. So you agree this in advance, has to be agreed in advance. Like if not, like once your account goes to zero, you're going to have to, it'll be blocked. You won't be able to use it. Your cards will be refused, so on and so forth. But once you've agreed it, it can give you quick access to funds when you need them in the short term. So if you kind of you can arrange, have for the next year, next 2 years, whatever it is, a $10,000 overdraft. You just know that if money's tight for a month or two, you can dip into that overdraft and it's not going to be a particular issue for you. Other than this is a expensive option because the interest rate that they'll charge on an overdraft is actually higher than what they would charge if they just lent you the money in the first place. So while there's a level of convenience to it and you could kind of dip in and out of it, you don't want to be using it too often because they do slap a pretty big interest rate on you. So it's an expensive way to access money. Again, though, you still retain full control because you're not giving away a portion of the business, unlike with the equity. So again, you've got to think of all these different, if I go down this option, what are the advantages or the disadvantages? And the fifth one is the newest type of sourcing finance, crowdfunding. So you may have heard of this, you may not. This is a modern way of financing a business. Okay, so this is kind of financing a business through donations of money from the public. Okay, now in class we'll actually get you clicking around one or two of these and it'll give you more of an idea. But there's a number of social media platforms now that offer entrepreneurs a platform for promoting and funding innovative prototype projects. So here are some of the Kickstarters, probably the best known one. Indiegogo is pretty well known. So if you clicked onto those websites, you would see what I mean. Basically, the entrepreneur sets up a page on one of those websites and it gives details of their product. It gives lots of details around the project and the budgets, and it sets a funding goal. So it might be, the funding goal might be, we need to raise $50,000 in the next 6 weeks. Okay. And then that page is open for people to contribute to the startup costs of that business. So it's a way of investors investing in a business as well. If people, members of the public, want to support a particular project, they donate money towards that startup fund and they are then called a backer. And in return for that money they've provided, they get incentives or rewards based on the amount donated. So that will really vary. So it might be discounts on product when ultimately it hits the market. It could be merch or other forms of discount. So there's lots of different ways that this kind of plays out. A couple of advantages of doing it this way is you get a commitment from your customer base from a really, really early stage, like pre-production. So you've got people kind of buying into your business idea and the idea of this product from very, very early on. And that then allows you to be in contact with them through production. And you can also get feedback from them as well. So this is one of the rare opportunities as a business or a potential business owner for a business startup to actually get some feedback from customers before you even sold anything, because the customers are kind of involved pre-production. So that's an interesting way of thinking about it. Some issues though, you might not reach your funding goal. So when you go onto these websites, you'll see, I need $50,000 within 30 days or $1 million within this period of time. If you never actually get enough donations to reach your funding goal, this all can end up going nowhere because you haven't reached enough money to do what you need to do with that money. You also need to provide incentives and rewards that are going to resonate with your potential customers, which might take some creativity. And also, again, if you have a look at these websites, you'll see what I mean. You're competing with a lot of other projects on these crowdfunding websites. So if somebody, a member of the public, a potential investor is thinking, I might start looking at getting involved in some crowdfunding, they go into Kickstarter. There is literally thousands of different projects listed on that website at any one time. And it can be just an absolute headache, just even trying to sift your way through them and trying to find out what might be a good one, what might not be. So there's a lot of competition in this space. Look, just a couple of examples here. Look, Birchall, okay? This was an interesting one. The top 20 crowdfunding campaigns of 2022, each raised more than $1 million for innovative Australian startups. The top of the list was this business, Birchall, who raised its maximum target. It was looking for $3 million within hours of offering shares via its own platform. So what's interesting with that one is this is actually a crowdfunding platform itself. So it kind of funded itself through its own crowdfunding platform. So it's kind of a strange one there. So almost 600 investors between them chipped in $3 million needed. So yeah, that's an interesting one because it was crowdfunding to fund its own crowdfunding website. So you can now go to Birchall and crowdfund other projects. Kind of weird one. But one thing I did find is that successful. A lot of the most successful businesses that have used crowdfunding over the last couple of years were kind of alcohol-based, like these, little breweries that have started up. So Your Mate's Brewing Company reached its maximum funding target of $2.5 million in an hour and 54 minutes in 2022. It was the third biggest raise of the year. Another one was Black Hops, another alcohol-based company. Hit its $2.2 million funding in a day. So it compares the average of 15 days on the market for Birchall's top performers, an average of 21 days for the top campaigns. So yeah, I just when I started digging into this, I just noticed that microbreweries and brewing companies seems to be a thing for them now. I guess if you think about it, often their customer base is going to be young professionals. They might be the most likely people to buy into this whole idea of crowdfunding. So there might be some crossover there. But yeah, it was just interesting to see that. So now you hopefully understand a little bit about what each of these things, so equity, debt, grant, overfunds and crowdfunding, what each of them means. And, with each of them, maybe a couple of advantages and disadvantages. So when you're planning a business and where you're going to get funds to start the business from, you now have a bit more of an idea about what your different options are and how they compare with one another and which route you might actually take. And that is it for this video, guys. So Key Knowledge 7 knocked over. I will see you in the next video for Key Knowledge 8. Cheers for now.